What's up, traders and investors? Welcome back. In this particular tutorial, I want to focus on something that is largely overlooked by a lot of newer investors, and in some cases, longer term, even successful investors. But this is going to focus on risk reward in a per trade basis. We're also going to focus on win loss in a sample size of, call it, 10 different trades, so your win loss ratio, and how your position size will greatly affect your overall net outcome of winners and losers. So I've already kind of built a 10 trade sample size. So we're going to take a sample size of 10 trades and say, what if, as a newer investor, and I see this a lot, a new trader wants to stick to small position sizes until they can feel like they've got it right. They're seeing some profitability, and they'll go through 10, 20, 30, 40, 50 trades, or 6 months of just doing 10 shares until they see profitability. And then they'll start to increase to 20 shares or 30 shares, or maybe you'll start off at 100 shares, or if it's options or futures, you'll start out at a 1 contract position. And so here's why I want to show why just starting off with a consistent position size doesn't typically work. Now, you can see position size 1 contract apiece. So we'll assume it's options, it could be futures, or 100 shares of stock. So you take in each trade, what are you risking in each trade? And the risk can always be defined by the difference between your entry price and your stop loss. So wherever you got in and wherever you get out when you're wrong on a per share basis, you have a certain amount of risk attached to that trade. And so if you trade 100 shares or a 1 contract position, your risk in trade 1 may be $100. And if your reward potential is $200, you are shooting for, in your plan, a 2-to-1 reward to risk ratio. And let's say that at a minimum, you look for a 2-to-1 reward to risk ratio in every trade, or you just simply don't take the trade. This is what we do at TradersArmy, and so you may follow the same rules and guidelines in your plan. So let's assume that we have $100 worth of risk to make 200 in trade 1, and we lose on that trade. Well, we lost $100, no big deal. And let's say that you started out with a $20,000 account, and your $20,000 account, you're willing to risk 1% of your account in a single trade. So in this case, you lost 0.5% of your $20,000, because 1% of 20,000 would be $200. So in trade 2, the risk was on 1 contract, $200. You stood to make 400, and on trade number 2, you actually won on that one. So you made $400. On trade 3, 1 contract trade was $150 worth of risk in an attempt to make 300. Well, you got stopped out on that trade and you lost 150. Trade 2, you were risking 175 on 1 contract in an attempt to make 350, and you won on that one. You made your 350. The next 3 trades were all risking anywhere between 150 and $200, and you lost on all 3. But then on the next trade, you were risking 100 to make 200. You actually won on that one, and you won on the one after that. So you're risking 50 to make 100. In the 10th trade, you were risking 200 to make 400, and you lost on that one. And if you look at this, if you were to add all these up, I'm just going to select the ones that we lost money on, okay? And you can see down here in the bottom left, the sum is we lost $1,000, okay? Now, if you add up the ones that you made money on, you made $1,050, okay? Which, you made $1,050. It covers all your losses, but after you consider commissions, did you really make any money at all? You didn't make any money at all. Why is that? Because with a 40% win ratio, which is basically what this is, 4 out of 10 trades were winners, 6 out of 10 trades were losers. With a 2-to-1 reward to risk ratio, you can be extremely profitable when you have a win-loss ratio of 40% winners, 60% losers, with a 2-to-1 reward to risk. You can be very profitable. The problem is, and here's where most people overlook, is your risk in each trade is, in some cases, wildly different. Therefore, your reward in each trade, in a lot of cases, can be wildly different. Therefore, who cares if you have a 2-to-1 reward to risk ratio if you don't have a consistent data point? And you might think, well, my 1 contract is a consistent data point. That doesn't work. If your risk and or your reward is not consistent in every trade, your net outcome will be skewed and not in your favor typically. And when you have risk that varies, as we see here, you have rewards that vary. You now become very biased as to which trades you actually would like to win on, which ones you prefer to win on, and which ones you'd prefer to lose on. But as investors who don't control the market, all you can control is your risk. All you can control is your reward. Okay, how much you lose when you lose, how much you make when you make. That's all you can control. We can't control which ones we win or lose on, and obviously, everyone, if they had a choice, would want to lose on the trades that cost them the least amount of money and win on the trades that made them the most amount of money. And if you could control that, then this outcome would be very positive. But we can't control that. All we can control is how much we lose when we lose and how much we make when we make. So when I go over and I say, let's approach this differently from a position sizing standpoint, let's go back for a second and take that $20,000 account and say, with 20 grand, I am willing to risk 1%. So 1% per trade. So if you're willing to risk 1% per trade, that means you're willing to risk up to $200. Now, here's what we're gonna work with. Not just up to $200 per trade. We want to change the position size to get as close as possible to that $200 without going over. So in this case, if the per contract risk were $100, then our position size would need to be 2 contracts in order to make the risk $200, okay, which would make the reward potential $400 if you traded 2 contracts. Now, trade number 2 has $200 per contract risk on a single contract, so I can't trade more than one without exceeding my $200 risk tolerance. But you'll see the risk and the reward is the same now. Here on this third trade, while we're risking 150, if I do 2 contracts, I'll exceed my $200 risk tolerance, so I have to keep that at 1, which, it's close to 200, but not exactly 200. Because we're dealing with contracts and options and futures, you kind of have to go as close as you can to 200. But in this case, we can only do 1 contract. You can't do a partial contract. Now, if you were trading shares of stock, you could increase your share size just enough to get your risk right at that $200 mark. But you can't do that in futures or options. You could accomplish that with some of the micro positions and E-mini positions, just like you could accomplish that in Forex with the micro or mini or standard positions. But we're just going to keep it simple and just talk single contract size positions. So in trade number 4, you got to go with 1 contract as well. So risking 150 to make 350. Okay, I'm sorry, risking 175 to make 350. These next 2, you've got your max risk on single contract, so we're just going to keep those the same. 1 contract, 1 contract. But on this one, we're back to trading 1 contract for $150 worth of risk, because if we buy 1 more, or I'll say we trade 1 more, you might be shorting them, you might be going long, then you'll exceed your risk tolerance. On this one, we can do 2 contracts, which puts our risk at $200 to make 400 at a 2-to-1. This one has $50 worth of risk per contract. So in this one, we can actually do 4 contracts, and that'll get us right at $200 risk to make $400 reward. And then on this final 10th trade, it's $200 to make 400 on a single contract. Now let's explore what the difference is. We lost money on this last one as well, so we'll keep all the losers. We lost on the same ones. We lost on trade 1, trade 3, 5, 6, 7, and number 10. So we lost on the same ones, and we won on the same ones over here. So we'll just kind of keep the exact same win-loss ratio, keep the exact same trades that we lost on, the exact same trades we made money on. And what you'll notice is if we add all these up, let's just sum the ones that we lost money on. You'll see down here, we lost 150. This one I need to put a minus sign in front of it. Lost 200, lost 150. Yeah, good. So lost 200 plus lost 150, 200, 200, 150, 200. We lost about $1,100. Bottom left-hand corner. Okay, we lost about $1,100 in that trade. Or in that series of trades, I should say. Okay, gross losses. Gross profits, I'm only going to add the ones that we made money on. You can see down here we made $1,550, bottom left-hand corner. $1,550. Now you'll notice that the outcome is a $450 net profit versus a $50 net profit, neither of which are considering commissions. But a $450 net profit versus $50 net profit is a pretty big difference, considering that we won on the same trades and lost on the same trades. Why did we see a profit on this second round versus we barely saw a profit or basically broke even on this first round? Is because the risk in each trade is about the same amount of money. It's about the same amount. So when you're risking the same amount to make the same amount, understand it doesn't matter anymore which 6 trades you lose on and which 6 trades you made money on. And let me show you what I mean by that. Let's go ahead and say, well, we don't get to pick which ones we lost money on and which ones we made money on. So let's go and say, let's make all these losses. So we lost, okay. So these are the potential losses on the left-hand column. These are the potential profits on the right-hand column. So last time we lost on 1, 3, 5, 6, 7, and 10. Let's say that we won. Let's say that we lost on trade number 2, and we lost on trade number 3 and 4. Let's go with that. Why not? And let's say that we lost on these last 3 as well. So we'll just kind of mix it up a little bit. So we lost on trades 2, 3, and 4, and 8, 9, and 10, which is a different trades that we lost money on in the first round, which means we made money on trade 1, 5, 6, and 7. So those are the ones that we made money on this round. So what's the difference? Well, if we add all these gross losses up, we lost 1125. So about the same amount, okay? In this, we won 400, 400, 400, 300. We made 1,500, right? So yes, we won a tad bit less, but it didn't really matter which 6 we lost on or which 4 we made money on, because our position size varied, getting our per trade risk as close to our max risk tolerance as we could without going over. I can't stress enough how important it is, even for beginning investors, to manage your not only risk reward on a per trade basis to not exceed 1 to 2% of your account value. That's up to you, no more than 2%. But then also, I would encourage you to increase or decrease your position size to get as close to that max risk tolerance without going over, which means in some cases you might be trading 4 contracts, which might seem a little uncomfortable in your first 2 months worth of trading, but if each trade carries the same amount of risk, you won't be so worried about which 5 or 6 trades you lose on and which 4 or 5 trades you win on. I hope you found this helpful. If you have any questions on this topic whatsoever, definitely reach out to us at support@tradersarmy.com, and we're happy to help in every way that we can. If you want to save those questions for our open forums or our live trading rooms that we do twice each week, then definitely bring up those questions when we're in a live trading environment. And again, we're happy to help in every way that we can. Enjoy the rest of your day, and we'll see you soon. Bye-bye.